Corporate finance practice problem using Excel. Reverse stock split. Get ready, it's time to take our chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're in the practice tab as opposed to the example tab. The example tab in essence being an answer key. We have the information on the left-hand side, which we're going to populate into the blue area on the right-hand side, looking at a reverse stock split, which will be what it sounds like, the opposite or reverse of a stock split. The stock split resulting in more shares out there, generally decreasing the market price. The reverse stock split will result in less shares out there, typically increasing the market price. Now, from just what does it look like standpoint, it's usually not as good a thing to have the reverse stock split. It's not going to be as common, and we might be attempting to increase the price to what we think would be a reasonable level for the market. You would kind of like it to be the other situation where you're looking at a stock split, which might have a situation where you're thinking the price is too high, because you've been doing good and the price is going up, the value is going up, and possibly you then have a split in order to lower the price to get it into that sweet spot, possibly, so that it will be more marketable and possibly able to then generate more capital. So in this case, we might be in a situation where we are thinking that the price is too low, and therefore we want to reduce the amount of shares out there, which could have the impact of increasing the price to the level that we think it would be at. So let's see how this would then work out. We're going to imagine we got stock price at $4. The reverse stock split is going to be a 1 for 5. So instead of a stock split of a 5 for 1, 5 shares for 1, we've got a 1 for 5, meaning if you have 5 shares, it's going to be shrunk down to 1 share, kind of the reverse of the split. And the investor, we're going to imagine this from the investor standpoint who owns 100 shares at the starting point. So let's say that we have the investor. We're going to say investor owns shares at the starting point here of 100 shares. So they have 100 shares. And then the formula is generally, we're going to say times the split ratio. So the split ratio is going to be 1 over 5. Let's put an underline here, font group and underline. So that means that the split ratio is going to be equal to 1 divided by 5, or 1/5, the fraction. And we're going to go to the number group, add a couple decimals there. That's going to be the 0.2 or 20%. And then we can go to the font group and underline. Let's put an indentation here while we are at it. So alignment indent. And that's going to give us the shares. Let's call it the shares after the split. And that's going to be equal to the 100 times the 0.2 or 20%. Now, if you're thinking about this just as like a formula, you might say, well, why do I can clearly see that I can just basically take the 100 divided by 5 here, and that'll give us our 20 that we're looking for. I can take off the decimals. But you got to imagine, of course, what is happening. It's a 1 for 5. So if this was to change to something like 2 for 5 or something like that, then it's important to know what the fraction is going to be, because that'll have an impact on our result here. So you kind of want to be careful to visualize it. Don't just know the formula, but kind of understand what is happening, so that if it's phrased a little bit differently, you picking up the right thing. If you pick up any shortcuts, make sure that you understand what the shortcuts are doing and why they're doing it, and when there might be an exception to it. So then we got the price after the split. What's going to happen to the price after the split? This is what we would expect to happen, but remember that the price is reflective of the market. So the market, you would think, would react given the fact that there's no other underlying conditions taking place, just like with the split, meaning no change to assets, liabilities, or income. We simply have less shares out there. So this is what we would expect for the price in that case, how the market would react. Beginning stock price, we're going to say, was at $4. $4 was the starting point, but then we're going to multiply it times the 1 divided by the split ratio. 1 divided by the split ratio, and so I'm going to say 1, and then the split ratio as we calculated up top, I'm going to say the split ratio is 1 over 5 in our case, which we calculated up here, so I'm just going to pick it up at that 0.2 or 20%. Font group and underline it. Let's go ahead and number group percentify it, and that's going to give us then our calculation of 1 divided by the split ratio. And let's go ahead and do some indentations here. We're going to go ahead and say, let's indentate that. Let's indentate that. And let's indentate that. And then we're going to say that that's going to be then equal to 1 divided by the 20% or 5. So now we've got the 5, and that's going to give us our price after split. That's going to be even, right? That's even 5. We're going to underline it, font group and underline, and that's going to then give us the 4 at the starting point times the 5, or 20. So we would expect then to be at a price of 20, given the fact, again, that nothing else changed. The price was at 4 before, and now basically we've got, you know, we've reduced it by 1/5 of the shares. So for every 5 shares, we now have 1 share. So you would expect then the price to be the 4 times 5, or price after the split, of 20. However, you could see that there might be a negative impact on the market, meaning they could see this as a bad sign to put this into effect. So it could be the case where the market reacts negatively and says, well, we see that as a bad sign, so maybe the price is only increased by the 80%. So you could have a situation, for example, because it is market driven, where the market's saying this is a bad sign, we're only going to increase by the 80%, let's say, and the price then would be the 20 times the 80%, or possibly over only then the 16. Let's make this a percent number group, percentify it, adding, I don't need decimals, I need underline, font group and underline. So we could see something like that taking place as well. What would happen to the investor value? Let's think about the investor beginning value, where they had shares of 100 shares up top. Starting point, 100. Stock price, so stock price was then $4, I believe it was. $4. Let's underline that by going to the font group and underline. That's going to give us our value. So the starting point was the 100 shares times 4. But then after the split, let's think about after the split, and we're assuming the change was for the full change and not that 80% reduction first. That would mean that we then had the shares of, how many shares did we have afterwards? Was like 20, I think. We had 20 shares after the reverse split. Now we only got 20 shares when we had 100 before. But the price of those shares, the price is now at, if everything went smoothly in the market and the market didn't decrease the price due to this action, we're going to say it's at 20. 2020, font group, underline, and that's going to give us the value, which would be the same. That's what you would expect to happen if everything else was equal, because there's no change to the underlying conditions, just like with the stock split. But again, if the market perceives that action as negative, then, and we have that reduction in the price, then we could say, all right, what would happen then? Well, we'd be at the 20 shares, and the price now we're going to assume didn't reflect the full change, but the market said that doesn't look good. That doesn't look good. So we're going to reduce the price to 16 over here, and we're going to go to the font group and underline. How do they do that? The market does that by not, buying and selling for that value. And they're going to say then that means that the investor has a reduced value of the 320 in that case, and it would have a negative impact on them, even though it kind of shouldn't. Just like the stock split kind of shouldn't, because there's no change in the underlying conditions, just a change in the number of shares out there. But again, the market could perceive that as a negative thing taking place.